I am very excited about the information we will be bringing to you. I think you're in for a real treat. Credit scores have become a pretty hot topic over the last several years, and I think it's important that people understand what is a credit score, how a credit score can affect you, how it can work for you if managed properly, and how it can work against you if not managed properly. My name is Sarah Landrum. I am the Community Financial Educator at DCCU, and during today's webinar, What Goes into a Credit Score, we are going to be talking about what your credit score can affect, the 5 factors of credit scoring, how you can obtain a free copy of your credit report, how to read a credit report, and how to build and repair your credit. We wanted to mention a couple of things before we get started. Everyone should have a question box, so as we go through the information today, you can put in your questions, and at the end of the webinar we will have a question and answer session, so hopefully we'll be able to answer all of your questions. And if anyone has been following us on Facebook, you may have noticed over the last couple of weeks we have been posting some questions to our audiences about credit scores. So we want to put one of those questions up as our poll question today. So which of the following might use your credit score? A financial institution, B, an electric company, C, an auto insurance company, D, a cell phone company, or E, all of the above. I'll give you a few minutes to make your choice. Thank you for your answers, and most of you can see that it is E, all of the above. And as we go through the information today, you will be able to hear why these companies use credit information to make their choices and whether to give you services or products or not. The first thing that happens when you go to a lender and you ask to borrow money, they are going to pull your credit report. And a credit report is just a copy of your debt obligations, how well you have paid them, have you paid them on time, and then once you have a loan with a lender, they will report the information to the major credit reporting agencies, which is TransUnion, Equifax, and Experian. And there is some dispute on how credit reporting started, but rumor has it in the late 1800s to early 1900s, there were a group of men who traveled the country, and they made notes on how well people paid their debt back to merchants. So when a customer came to a merchant and they asked for credit, that merchant would call whoever was in their area with their notes, and they may hear something like, Mr. Smith pays his debt on time and in full, or Mr. Jones, he never pays back. So this is how credit decisions were made. Of course, we know that would never work with us today, these methods, because credit score, there's a lot of federal regulations in credit reporting, and there's also high usage of debt throughout the country. So in the 1980s, lenders started using a more standardized way of making loan decisions. They used a point scoring system that actually scored what the components of someone's credit report is. And a credit score has a range of anywhere from 300 to 850. And while most of the general public, they have associated credit scoring with those high-ticket items such as your mortgage loans and your vehicle loans, what a lot of people don't know is other companies who actually look at your credit information to make those decisions. And one of them would be insurance companies. Insurance companies write auto insurance policies based on your credit information. Although there is a big dispute about this, there are some companies, and one in particular, the University of Texas has done a study that shows a strong relationship between someone who has a low credit score, the number of claims that they file, as well as the dollar amount is a lot of times more higher than someone who has a higher credit score. Cell phone companies will also, before they write a contract with their customers, they will look at credit information. They don't want to do business with people who don't pay their bills on time. They don't make their debt obligations on time. And something else that cell phone companies will do is a lot of times they offer that phone for either a very minimal cost or even free. So in order for them to recoup the cost of the phone, then they look at your credit information to make that determination of whether they write that contract for you or not. And just a good example of this would be the iPhone 6 that just came out. Of course, if you went out to buy it, it would cost about $650 retail price. So there's one particular provider right now who's offering it for free, so they definitely want to make sure they are making contracts with people who are going to pay their monthly bills so they can recoup some of the cost of that. Financial institutions and government jobs have a higher risk of embezzlement and fraud. So a lot of times these employers will look at your credit information to make a determination of whether or not they're going to hire you. They also can use this information when there's a choice between two different employees or people that they want to hire. It is shown that people that have collections, they have delinquencies, they have judgments, have to spend more time, so that could pull them away from the job versus someone who has a higher credit score. So why is your credit score so important? Well, first of all, your credit score is going to determine whether or not your loan is approved. Let's say maybe you need a new car loan. Your car is broken down and your credit score is so low that you may not even be able to get that loan approved. So it's very important anytime you go out to obtain a vehicle loan, a mortgage loan, a credit card, anything like that. It also determines what your interest rate is. The higher your credit score, the lower your interest rate is going to be. And over the course of a loan, that is going to save you money. And saving money is, very important. We all want to put a little bit more in the bank to fall back on. Take, for example, a mortgage loan. You can pay that over a longer period of time, and if you have a low credit score and you have a high interest rate, in return you're going to be paying several thousand of more dollars than you would if your credit score was higher. And this is what I like to kind of call the meat and potatoes of your credit score. It's the factors that make up what your credit score is. And 35% of your credit score is based on your payment history. When you pay your debt on time and in full, this is always favorable to your credit score. But if you have delinquencies, if you have collections, if you have judgments, that can all have a negative impact on your credit score. So you always want to pay everything as much as you can on time and in full. 30% of your credit score is the amounts that are owed, and this is the ratio between the outstanding balance versus your available credit limit. We like to recommend that you always keep this under 30%. And to give you an example of what this means, let's say you have a credit card and it has a $5,000 credit limit. You should never have your balance go over $1,500. You always want to keep it under that 30% mark because it indeed can affect your credit score. So 35% is your payment history, 30% is the amount that you owe. So that's 2/3 of your credit score. So if you pay everything on time and you don't max out your credit cards, then you're 2/3 away from having a good credit score. Also, the length of your credit history, that is 15%, and that just basically means how long that you have used credit. The longer, the better, because you have a longer credit history. A lot of times I've had someone come in and say, hey, I've had a car loan, I've paid on it for 3 months, I've paid on time, I'm going to have an 800 credit score. Not necessarily, because a lender, of course, wants to see that you're paying it on time for 3 months, but they also want to see that you're able to pay it on time for a year, 2 years, 3 years. And then the type of credit that you have is 10% of your credit score. A mix is more favorable to a lender because they show that you can handle different debt obligations. So having a mortgage, having a credit card, having a vehicle loan, that can be more in your favor than just having credit cards alone. And the last thing that I want to talk about, and I'm going to talk about a little bit more, is new credit. That is 10% of your credit score. And what I mean by new credit, you'll hear a lot of times people use the word inquiry. But of course, when you go to a lender and you want to borrow money, the lender is going to pull your credit report, and they're also going to see if anybody else has pulled your credit report. So when you ask for a vehicle loan or you ask for a credit card, you're going to a lender and you're requesting it. That is called a hard hit on your credit, and that can affect your credit score anywhere from 2 to 25 points, and it's looked at over the course of a year. However, there are soft inquiries. They will not affect your credit. A soft inquiry would be maybe an example of an employer pulling your credit. You're applying for a job. That's not going to affect your credit score. If you get a copy of a free credit report, that's not going to affect your credit score. You're not asking for debt. You're only using it for informational purposes. So let's talk a little bit more about how you obtain a free credit report. On December the 4th of 2003, George W. Bush signed an amendment to the Fair Credit Reporting Act, and this enabled consumers to get a free copy of their credit report from the 3 credit reporting agencies, TransUnion, Equifax, and Experian. And what I would like to do is take you to that particular website, because you want to make sure anytime that you're getting a copy of a free credit report that you're using the correct website. A lot of times you go to Google and you just put in free credit report. It may take you to a site that is not actually free. It may ask you at the end, after you put in your information, to put in a credit card. So I just want to make sure everyone is educated on the correct site, because the correct site was in cooperation. That was made between the 3 credit bureaus as well as the Federal Trade Commission. So let's take a look at this real quick. And we are at annualcreditreport.com. Make sure that's where you go. And just kind of looking at the website, and as we go up the page, you will notice over here that the website is brought to you by Experian, TransUnion, and Equifax, the 3 major credit reporting agencies. Sometimes I'll have someone ask me, should I get all 3 copies of my credit reports at the same time? Should I spread it out over the course of the year? And my answer to that would be, it depends. Let's say you're getting ready to apply for a mortgage. A lot of mortgage lenders will look at all 3 of your credit reports, and there could be something on one that may not be on the other. So in that case, I do recommend that you get them all at 3 at one time, in case something shows up and you need to get that corrected before you apply for the mortgage loan. However, if you're just doing it for fraud and identity theft purposes, then I do recommend that you spread it out over the course of a year. Maybe you get one at the beginning of the year, one in the middle, and then one at the end. That way you can monitor it and you can know what's going on with your credit report. And if something shows up, then you would immediately know. And the next thing we're going to look at is a sample of a credit report. I have a copy of a very basic credit report. Now, one thing that I do want everyone to know is when you get a credit report from annualcreditreport.com, what a consumer sees is an educational report. It's just a tool to help you understand what is on your credit report, what it looks like. When you go to a lender and a lender pulls a credit report, it's different. It has a lot more information on there to help the lender make a loan decision that necessarily the consumer really doesn't need to know about. So let's go to our sample credit report. And just to kind of, like I said, educate you on what it is going to show on your credit report. If you look here, you'll notice that your personal identification information, your name, your address, your social security number, because everything is reported in your social security number, your date of birth, your telephone number that may or may not be on there. It depends on when the lender or what the lender reported to the credit bureaus. Employment date, who your employer is, what kind of job or occupation that you have, your hire date. When you apply for credit, your lender wants to know that you have a job, and they want to know where you work so you can pay that debt obligation back. So they will report that information to the credit bureaus. Public record information. If you have filed bankruptcy, if you have any collections, if you've had judgments, all of that is going to show up in the public record information. And then as we go down just a little bit here, you'll see all the accounts that you have. You'll have a company name. Who do you have that particular account with? What is the account number? And you'll notice there's some codes in here. For example, this is a joint account. The J means joint. A, that means you're an authorized user. You may not be obligated to that debt, but you're able to use it. What the balance is, the last date that that was reported. So your credit report has a lot of information about you. And as we scroll down here, most of your credit reports that you're going to get, although they're going to look a little bit different from each one of the credit reporting agencies, the information should generally be the same. There will be status codes to kind of help you know what like J means or what R means, revolving credit. So that way you'll hopefully be able to read it a little bit easier. Another thing that I want to mention is when you get a copy of your free credit reports, that does not entitle you to a free credit score. And I'll explain that a little bit more. Your credit report is yours. It's your information. However, each of the credit reporting agencies, TransUnion, Equifax, and Experian, they all have a model that they use to rate your credit and make you a credit score. That does not belong to you. They made the model. So that's why you have to pay for your credit score. And usually it's about $7.95, $8.95. Once you pull your credit on annualcreditreport.com and you look at your report, it will give you an option of ordering your credit score, but of course you have to pay for that. So let's look at if you have no credit. How do you build credit? The first thing that we like to recommend is to open a shares secured loan. What that means is you may have money into a savings account that you've saved. You can apply for a loan. We place a hold on that money, and as you pay the loan, that information is reported to the credit bureau. Of course, it builds a credit history. And as you pay the loan down, the hold on the money that you have in the savings account also goes down. open a share secured credit card, and basically what that means is it kind of is a lot like the share secured loan. You have money in an account set aside in the event that you can't pay it back. However, you're using a credit card, you're using that to build credit history. Something else that I like to recommend is if you use a secured credit card, as you use it and you build that credit history, maybe try to apply for one that is unsecured. And one of the best places to get or to use is a store credit card. And that helps you to build that credit mix and show a lender that you're able to handle not only a secured credit card, but also an unsecured credit card. Pay your rent and utilities, cell phone, those different things on time. Even though they're not reported to the credit bureaus, sometimes a lender will ask for a letter of credit, and your landlord may be willing to write a letter and say, yes, you've paid your rent on time for the last 5 years. Or your electric company, yes, they've been on time making their payments for 3 years. And that can help you sometimes to get a loan approval just by showing your lender that maybe you haven't had any credit in your name, but the obligations that you have on a monthly basis, you have paid those on time. We recommend, too, that you can apply for a small car loan, let's say maybe $8,000, and then you've saved 10 to 20% down. You have money in a savings account, you're able to put that down on the loan. A lender likes to see that because they see that you're able to save the money. So if you were able to save it, you're probably going to pay that monthly payment. They know that you're serious about that. Unfortunately, things happen because of human error. A lot of people have similar names. Some people have the same name. We have juniors, we have seniors. And unfortunately, information can be reported wrong. So let's say you get a copy of your credit report and there's something on there that doesn't belong to you. What do? The first thing is, of course, you get the copy of the credit report, and then whatever that item is that you have in question, circle it. Prepare a letter of credit to the credit reporting agency. Prepare a letter to the creditor. Whether or not you open the account, I can't stress this enough because sometimes people feel like, well, I didn't do it. I shouldn't have to take care of this. It's not my problem. Well, it really is your problem because it's showing on your credit report. It's affecting your credit score. So make sure, even though you may not have opened the account, maybe it's a fraudulent account, let that creditor know. They don't know who you are. They just know somebody's not paying the bill. So if you keep in contact with the creditor, then they will definitely work with you if they know that you are disputing this with the credit reporting agencies. Also make sure that you mail everything certified. You make sure you have a signature. You know that your information has been received. And then wait for a response. You should receive a response from the credit reporting agency or agencies anywhere between 30 to 45 days. And if that credit reporting agency is going to remove that from your credit report, then they should send you a new copy of your credit report showing that it has been removed. If for some reason you're or they're not able to remove it from your credit report, you do have the right as a consumer to write a 100-word or less summary that can be attached to your credit score or your credit report, and then that way when you go to a lender and they see something negative on your credit report, they can see that you've disputed it and whatever your side of the story is. Here is the information to contact the credit bureaus, the website, their address, their number. We will be emailing the presentation out to everyone after the webinar finishes, so you'll get this information, so don't worry about writing it down right now because we'll send that out to you. One of the unique things that we do here at DCCU is we want to help people with understanding their credit report and understanding their credit score. So if anyone is interested in meeting privately with me, then you can contact my information will be on the presentation. So feel free if you have any questions, if you pull your credit report and you just don't understand it, please feel free to contact me. And that is all the information that we have for you today. We hope you've enjoyed it. Now we're going to go to the question box and we're going to see if we have any questions, and hopefully we'll be able to answer them. Okay, well that's a very good question. The question is if I have a bad credit score, will I not be able to obtain car insurance? Not necessarily. When car insurance companies write policies, of course if you have a higher credit score, you're going to have a lower premium. If you have a low credit score, your premium is going to cost more. So not necessarily will you be denied for insurance, but you may in the end pay a higher premium than you would if you had a favorable score. Okay, and we have another question, and it is, what is the quickest way to build my credit? And that's a great question. Of course, we had on the slide, and let me go back to the slide here and pull these up again. What if I have no credit? Of course, we recommended that you open a share secured loan. That's a great way for you to build credit if you have money saved. Of course, if you don't have money saved, one of the recommendations would be to take out a store credit card. Charge something, pay it back at the end of the month, and then that way you don't have to pay any interest. But one of the things that I wanted to point out is that factor of your credit history. Of course, when you start having loan obligations, you're going to start building history at that point, but what you would want to do is just to continue on building that history. So I guess what I'm trying to say is it takes time to build a credit report and to build a credit score, but of course as soon as you start using loan products, you start building it at that point. So there's not a really quick way. It just takes a lot of time because of the different factors that make up your credit score. Okay, we have another question, and let me read this. I was hospitalized for a while and got behind in my bills, thus, of course, dropping your credit score. In an instance, what can I do now that I'm back on track? Okay, well, hospital bills, of course, they can play a factor in your credit report and your credit score. What I would recommend, the first thing is you need to talk to whoever is in billing at your hospital or whoever takes care of the billing there. I would recommend that you set up some type of payment plan with them. One of the things that I kind of like to, I guess, recommend is that with hospital bills, a lot of times they'll allow you to make a minimum payment. And if you can make that payment plan with them, that really helps get that debt obligation back on track. And also, too, a lot of times when you make that payment plan with them, you don't have to pay interest on a hospital bill as you would on a vehicle loan or a mortgage loan. So I wouldn't recommend that you pay it off in full unless it's a low balance. But if you have a very high balance, I do recommend that you make a minimum payment and pay it along, and don't worry about it at this point because you're not paying interest. And if you're not paying interest, it's not costing you any more money. Another good question, does applying for a store card classify a hard hit? I don't want my credit to get worse due to applying for a store credit card. Anytime that you ask for credit, you're wanting to take a loan out, that is a hard hit on your credit report. Only, it's not a hard hit, but a soft hit when you aren't asking for credit. Now we have a lot of questions coming in. Let's see what our next question is. What is the difference between a FICO score and others? Well, FICO stands for the Fair Isaacs Company, and they are the company that started using the credit scoring model, and they actually work with the different types of credit bureaus to assist them with the model. However, each of the credit bureaus, Experian, TransUnion, Equifax, they have their own models that they have come up with, but most of the models are very, very similar. So if you were to go to the FICO website and get a credit score and then you got one from Experian or TransUnion, they're going to be very similar. You might see a little bit of a difference, but they should be very similar. Well, I think we have answered all of your questions today. We are going to, like I said, send out the presentation. As you go through it, if you see anything that you might have a question about that you didn't think of during the webinar, please send that information to us, contact us. We would love to answer your questions, and we'll be sending you also a short survey. So please fill that out because we always want to do better with the information, and we want to know what kind of information that you would like to see in future webinars. Thank you, and I also wanted to say thank you before we hang up to my partner over here, Sam Balzerman. She has helped me put the webinar together today, so I wanted to also thank her.